even with this inflation, the numbers prove Americans keep spending. But it turns out, at least recently, we've been using our credit cards to do it. And now credit card debt has just hit a record high. That's according to today's household debt report. Americans racked up more than, wait for it, $1 trillion in credit card debt in the second quarter of 2023. That is the highest ever. And that has led to a slight increase in overall household debt. The next highest contributor to household debt, auto loans, which increased by $20 billion in the second quarter. Mortgage balances were basically unchanged from the previous quarter, and student loan balances actually fell by $35 billion in the second quarter. So what does this mean? Well, experts say household budgets had benefited from excess savings and pandemic-related debt forbearance for the last few years, but all that stuff is now gone or almost gone. So people are turning to their credit cards to spend. Now, don't get it twisted. The numbers show we are not slowing our spending. We're just turning to credit cards to spend. But we know those things are expensive. The average credit card interest rate is like 20%. So with less of a cushion in savings to pay off that monthly payment, debt is probably going to start racking up big time. So it's likely that spending will start to slow down finally, which would then slow down the economy and then would continue to reduce inflation. It's also possible these debt numbers are going to get worse in the fourth quarter when federal student loan payments start back up again. I bring all this up to you not to bum you out, but to share with you some of the reports like this one that the Federal Reserve uses when determining whether it's appropriate to raise interest rates again. The Federal Reserve is set to meet and decide that in September.